Hi, everybody. This is Alan Ellman, the blue collar investor, welcoming you to this BCI podcast number 84, titled Analyzing and Calculating a Multi-Leg Rolling Down Covered Call Trade. We're going to use a real life example with Nike Inc., which trades on the New York Stock Exchange under the ticker symbol NKE. Now, folks, I'm selecting one series of trades selected from one of my option selling portfolios just to highlight how important it is to stay with a trade right from the beginning till the end, because multiple exit strategy opportunities could arise. And frequently, we could take what appears to be a losing trade and mitigate those losses and sometimes even convert a loser to a winner. Let's start by defining what is rolling down as it pertains to a covered call trade. Well, once we buy the stock and sell the option or the short call, then we buy back the option. We call that buy to close or BTC on our broker trading platform. So we buy back the short call and sell a lower strike in the same contract month. So for example, we sell the 50 call, we buy it back and sell the 48 call. That would just be a hypothetical example here. Now we base these decisions in the BCI methodology on the 20%, 10% guidelines. Now, for those of you not familiar with that, what that means is in the first half of the contract, we buy back the option automatically when the price of that option drops to 20% of the original option sale price. So, for example, if we sold the option for $2, we would buy it back at 40 cents or less in the first half of the contract, and then 10% or 20 cents or less in the latter part of a contract. Now, we enter that buy to close limit order immediately after selling the original covered call option. So let's say at the beginning of the contract, we buy a stock and sell the option for $2. Seconds after we sell that option for $2, we enter a buy to close limit order at 40 cents or less, good till cancel. And then we change that to 20 cents or less midway through the contract if that original threshold is not met. Let's have a look now at a real life example taken from one of my option selling portfolios using Nike ticker NKE. So on June 22nd, 2020, I purchased Nike for $97.72. We're going to use one contract examples here, makes the math a little bit simpler, but the percentages will be precisely the same no matter how many contracts we use. So once the stock was purchased and we were covered or protected, I then sold the 99 out of the money call for $1.60. That's a 7/17/2020 expiration. So a little bit less than a month, about 3.5 weeks out. Now, once I sold that option for $1.60, I immediately entered the buy to close limit order at 20% approximately, or 30 cents. And that was placed as a good till canceled order, so as opposed to a day only, so I don't have to keep placing it every single day. I did make a note in my calendar 2 weeks prior to expiration to change that 30 cents to 15 cents mid-contract if that 30-cent threshold was not met. Now, if we were to look at the initial structuring of this trade, and for those of you also watching this podcast, we used the multiple tab of the Ellman calculator. We inserted into the blue cells on the left side of the spreadsheet the fact that Nike was purchased at $97.72 and that the 99 call was sold for $1.60. The white cells on the right side of the spreadsheet then become populated, and we see that the return on the option or RU for this time frame was 1.6%. Now that annualizes out to about 19%. We also have upside potential. If the price of Nike moves from $97.72 up to the 99 strike, we will have generated an additional 1.3%, making our maximum potential gain 2.9%, counting the initial RU premium plus upside potential. That would then annualize out to approximately 35%. So that's how the initial trade was structured. Let's see what happened. Now, the 20% threshold, which we entered immediately after setting up the initial covered call trade, that was never reached. So the value of that option never reached that 30-cent threshold. However, the 10% threshold, or 15 cents, was reached and realized for the first time on July 16th. So that was about a week before contract expiration. So what I did was I rolled down to the 98 strike. Originally it was set at 99. I rolled down to the 98 strike for 48 cents. The same day, I set a new 10% buy to close limit order, now on that 48 cent figure. So it was set at a nickel, 5 cents. Buy to good till canceled once again. Now, on the same day, that new threshold was reached as the price of Nike continued to decline. So it was reached, and that particular covered call trade was closed. The short call was closed also on July 16th. And a sell to open order was executed for the 97 strike. So we first set the initial call at 99. We rolled down to the 98, and then we rolled down again to the 97. That second roll down generated 13 cents. So for those of you actually watching this podcast as well as listening to it, I'm now showing a broker statement from one of my accounts showing that the buy to close orders were executed at 5 cents and 15 cents, and that the sell to open orders were executed for rolling down 2 times at 13 cents and at 48 cents. So each time we generated an option credit. So let's now show you how we converted a losing trade to a winning trade. The share price during the contract declined from 97.72 to 96.28. And that resulted in an unrealized loss of $144 per contract. So had we just purchased Nike at 97.72, at the end of this contract, we would be in an unrealized loss of $144 for every 100 shares that we purchased. Now, let's look at the option side. We received option credits of $1.60, 48 cents, and 13 cents, the latter two from rolling down, and option debits of 15 cents and 5 cents. And that was the buy to close limit orders, which we executed 2 times. So this resulted in a net option credit of $201 per contract. Now, factoring in the loss on the stock side of $144, that actually resulted in a gain of $57 per contract. So we did convert a losing trade just on the stock side to a winning trade. Now, this is a small amount of money we're talking about here, but we're talking about only one set of trades for a particular security in one of my portfolios in one of the months. Imagine doing this on a multi-monthly basis, multi-annual basis, and multi-decade basis. How much cash this can put into our pockets if we have mastered the skill set of exit strategies. So let's summarize here. Option selling exit strategies will absolutely mitigate losses and frequently will enhance gains or turn losses into profits, as it did with these Nike trades. Now, this Nike real-life example demonstrates how multiple rolling down exit strategies actually put cash into rather than out of our pockets. It's just a great example of how much control we have over our option selling trades. Before I go, if you want a free copy of that Ellman calculator that I used in this podcast, go to our website, www.thebluecollarinvestor.com. Look for the link that says free resources including the Ellman calculator on the top black bar of our web pages. Check out also our beginner's tutorial for both covered call writing and selling cash secured puts. On our blog page, you could sign up for our free weekly newsletter. I write articles every week. They include charts, graphs, calculations. They all have an educational component to it, and it's free. So you could sign up on the blog page and have a look in our store where we have all of our books, calculators, other spreadsheets, online video programs, trade planners, mentoring programs, and much, much more that'll help us all master these option selling strategies. So folks, thank you so much for taking the time to listen to and or watch this BCI podcast number 84, analyzing and calculating multi-leg rolling down covered call trades. I hope you enjoyed this presentation, and more importantly, hope it puts some money in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.